Weekly Economics and Finance.
The market remains highly focused on whether the Federal Reserve will cut interest rates in June. The overall financial market is moving according to this outlook, with bond futures markets currently indicating a 46% probability of a rate cut in June. To predict the future policy direction of the Fed, it is essential to monitor inflation trends. Overall, inflation is slowly declining in a major trend, but the heat of the real economy is preventing a drop in inflation, creating an uncomfortable situation for both the financial markets waiting for a rate cut and the Fed waiting for inflation to subside. To determine whether inflation is moving towards the 2% target, we observe expected inflation. While the one-year expected inflation is stable, the expected inflations for 5 and 10 years are gradually rising, suggesting a risk of inflation rising again. One of the main reasons inflation is not easily coming down is the rising trend in international oil prices. International oil prices are significantly influenced by geopolitical situations, supply and demand, and OPEC+'s production cut policies. Political instability in the Middle East, increased anxiety due to recent attacks on Iran's embassy by Israel, and the continuation of OPEC+'s production cut policy are fueling the rise in oil prices. Although the demand for crude oil remains subdued due to the slow recovery of the Chinese economy, the gradual recovery of China's economy could be a factor in further oil price increases. Additionally, the rising trend in other commodity prices, such as lumber and copper, is noteworthy. On the other hand, iron ore prices have remained relatively low due to the slow recovery of the Chinese economy. Attention should be paid to the CPI inflation announcement next week. The labor market situation also remains tense. The ADP Private Sector Employment Report and Job Report of Department of Labor released last week showed a significant increase in new jobs, greatly exceeding market expectations. Consumer sentiment has been on a rising trend since mid-2022, reflecting the strong flow of the real economy. This trend is confirmed in the Purchasing Managers' Index, PMI, with the manufacturing PMI surpassing the expansion baseline of 50 in March, and the service PMI also remaining above 50. The tight labor market and robust consumption, among other strong real economic conditions, could delay the Federal Reserve's decision to cut interest rates. Despite positive signs of gradually subsiding inflation and service sector inflation calming, there are still many obstacles to calming inflation as a whole. Reflecting these obstacles, in bond market, interest rates have risen, and the stock market has declined. The yield on 10-year government bonds has reached its highest level since entering 2024. It seems that the market is gradually losing faith in a rate cut in June. In January of this year, the market referred to the forecast of 3 rate cuts as a hawkish outlook, discussing 6 to 7 cuts. However, as of April, the forecast of 3 rate cuts is now considered a dovish outlook. Equity market also declined last week. It's a time when good news for the economy becomes bad news for the financial markets. As the real economy shows strength, the Fed may delay cutting interest rates further. This is bad news for stock market. If interest rates remain high, value stocks may start to receive more attention compared to growth stocks. Currently, growth stocks, particularly those related to artificial intelligence, AI, are considered representative. There is widespread criticism that AI-related stocks are in a bubble. Growth stocks are characterized by their high prices relative to their underlying assets or earnings, promising rapidly increasing profits, whereas value stocks are considered undervalued in comparison to their current assets or earnings. The surge in growth stocks is heavily reliant on the strong belief in a Federal Reserve rate cut in June. However, as this belief weakens, the upward trend in growth stocks is likely to be impacted. Over the past decade, value stocks have not performed as well as growth stocks. However, it's questionable how much longer the overvalued situation of growth stocks can withstand high interest rates. The CAPE ratio of the S&P 500 index has been higher than its current level only twice in history, indicating that the value of growth stocks dominating the current stock market is overestimated. Despite this, the earnings of American growth companies continue to perform well, showing that investors have an unceasing preference for them. However, the price difference between growth and value stocks has grown too large to ignore. Gold is haven. With interest rates positioned high, leading to a stronger dollar, one would expect gold prices to weaken. Yet, gold prices continue to soar this week. It seems the status of gold as a safe haven asset is being emphasized. With the strong real economy and market interest rates staying high, pressing down on growth, the logic is to secure gold before the stock market takes a hit. If there's a preference for safe assets, government bonds would also be a logical choice, but there's the risk of fiscal deficits associated with them. Investors seem to be flocking to gold, fearing that government bond prices could be suppressed by federal government bond issuance even if the Federal Reserve does not raise the benchmark interest rate further. Additionally, gold purchases are increasing in China. With the Chinese economy not rebounding as quickly, Chinese people are choosing gold as a safe asset. The Chinese affection for gold is notable.